Reading the Home Mortgage Disclosure Act out of the new Reference Guide to Regulatory Compliance on page 204. The Home Mortgage Disclosure Act, enacted in 1975, was enacted by Congress as a result of concern over credit shortages in certain urban neighborhoods. Congress found that financial institutions sometimes contributed to the decline of older urban neighborhoods through restrictive credit practices, particularly in the area of home loans. HMDA was enacted to require commercial banks and savings and loan associations to publicly disclose certain information about their mortgage and home improvement loans. This disclosure allowed the general public to determine whether the institutions in their communities were meeting the housing credit needs of the community by providing such loans. HMDA is only a loan disclosure law. It does not require institutions to make loans of any number or type. It simply requires lenders to disclose annually the home loans they do make. Several changes were made to HMDA in the late 1980s. In 1988, Congress amended HMDA to add several different types of institutions to its coverage. Also, under the provisions of the Financial Institutions Reform, Recovery, and Reinforcement Act of 1989, HMDA's requirements were expanded to add reporting requirements that became effective with the Report of Loans Made in 1990. Reg C was amended for the purpose of making loan data available on an expedited basis. The amendments required that loan application registers be updated on a quarterly basis rather than annually. Also, many lenders were required to report in a machine-readable format rather than on paper. In 2002, the Federal Reserve amended Reg C to require collection of reporting of additional data that included information on high interest rate loans beginning in 2004. In 2008, the Federal Reserve further amended HMDA to require the reporting of higher priced mortgage loans. The Dodd-Frank Act required the collection of additional data and transferred the authority of the regulation to the Consumer Financial Protection Bureau as of July of 2011. The collection of additional HMDA elements is not required until HMDA publishes regulations. Furthermore, the requirement to report HMDA data changed from being biannually to annually for all institutions regardless of size. I just don't recall exactly when that happened. Roman numeral 1, coverage. A. Banks, savings associations, and credit unions that originated or refinanced a home purchase loan secured by a 1 to 4 family dwelling other than a construction loan or temporary loan during the previous calendar year. If 1, 2, or 3, 1, the institution is federally insured or regulated. 2, the loan is insured, guaranteed, or supplemented by a federal agency. Or 3, the institution intended to sell the loan to Fannie Mae or Freddie Mac. For B, under coverage, for-profit mortgage companies whose home purchase loan originations, including refinances of home purchase loans, equaled or exceeded 10% of their loan volume, measured in dollars during the preceding calendar year, or to $25 million. C, exemptions. A bank, savings association, or credit union that neither a home nor a branch office in the metropolitan area. 2, a bank, savings association, or credit union with total assets of $43 million or less as of December 31st, 2013. This threshold is adjusted annually based on the change in the average of the Consumer Price Index for each 12-month period ending in November. 3, a for-profit mortgage company, provided it does not have an office or branch in a metropolitan statistical area, it has assets of $10 million or less, or it originated less than 100 mortgage loans during the previous calendar year. And 4th, any state-chartered financial institution that is subject to disclosure requirements under state law that are substantially similar to those under the regulation and adequate for enforcement as determined by the CFPB. So those are your exemptions. State-chartered financial institutions, for-profit mortgage companies that have low volumes, and low asset level bank, savings associations, or credit unions, or those that are not located in a metropolitan area. Loans covered are home purchase loans, which are loans secured by and made for the purpose of purchasing a dwelling, including condos, mobile homes, cooperative, single, and multifamily dwellings. 2. Home improvement loans, a loan secured by a lien on a dwelling that is for the purpose, in whole or in part, of repairing, rehabilitating, remodeling, or improving a dwelling or the real property on which it is located, and other loans, secured or unsecured, for the purpose of home improvement that are classified by the financial institution as home improvement loans. 3. Home equity lines of credit may be reported at the institution's option if they are made for the purpose of home purchase or improvement. Report only the portion of the loan that represents the covered purpose. 4. Refinancings of any dwelling secured loan that replaces and satisfies another dwelling secured loan. The purpose of the original loan is irrelevant. 5. Applications for pre-approvals of home purchase loans. If the institution issues a written commitment to the applicant valid for a designated period of time to extend a home purchase loan up to a specified amount, the written commitment may not be subject to conditions other than conditions that require the identification of a suitable property, conditions that require that no material change has occurred in the applicant's financial condition or credit worthiness before closing, and limited conditions that are not related to the financial condition or credit worthiness of the borrower, such as property-related restrictions. F. Dwelling. Dwelling means, so I just covered the types of loans that are covered. So you have refinancing, you have applications for home purchase loans, home equity lines of credit are covered, thank you, and home improvement loans as well as home purchase loans. Dwelling means a residential structure which, whether or not it is attached to real property and located in the U.S., District of Columbia, or Puerto Rico. This includes condos, cooperatives, and mobile and manufacturing homes. Requirements under HMDA from the CFPB's regulations, the U.S. Code, the appendix, and staff commentary to the CFPB regulation. A. Compiling home data. Must collect data regarding applications for originations and purchases of home purchase loans, home improvement loans, and refinancing where both the old and new obligation are secured by liens on dwellings. For each calendar year during those collected by electronic means, such as the internet, dwellings, and you have A and B under compiling loan data, under collecting data from applications. A being dwellings including residential structures, including condos and mobile homes, but do not include transitory residences such as dormitory rooms. And B, an application is an oral or written request for a home purchase, home improvement loan, or refinancing made in accordance with the procedures used by the institution for the type of credit requested. Number 2, under compiling loan data, applications for pre-approvals for home purchase loans that are denied or results in the origination of a home purchase loan must be reported. Applications for pre-approvals that are approved by the institution but not accepted by the applicant are reportable at the option of the institution. 3rd, home improvement loans not secured by the dwelling must be classified by the institution as a home improvement loan to be reportable. And 4, data must be in a report prescribed in Appendix A to Reg C, that's the HMDA loan application register, in a machine-readable format unless the institution has 25 or fewer entries per year, and data must be edited before submission. 5, data collection and submission requirement for compiling loan data. A, data may be collected on separate registers at different branches. B, data may be collected on separate registers for different loan types, but loan or application numbers must be unique. C, data must be submitted to the supervisory agency in one complete package with an officer certification of accuracy. 6, under data compilation, the data must include the following terms for each loan, including only loans and applications where final action was taken during the reporting year. A unique number for the loan or loan application and the date it was received. B, type and purpose of the loan. Type includes conventional, FHA, VA, FSA-RHS. Purpose includes home purchase, home improvement, refinancing. C, whether the application is a request for pre-approval and whether it resulted in a denial or in an origination. And D, the property type to which the loan or application relates, including 1 to 4 family dwellings, manufactured housing, or multifamily dwellings. E, owner occupancy status of the property to which the loan relates. F, amount of the loan or application. G, type of action taken and the date. And H, reason for denial, optional except for national banks and savings associations. That's the data to be collected. Are there more? I, location of the property to which the loan relates by metropolitan area, state, county, and census tract. If the creditor has an office within that metropolitan area, banks with assets of $300 million or more, and bank holding companies with assets of $1.202 billion or more, $1,202 million or more in December 31st for the preceding calendar year, must report property location for all applications. In Roman numeral 2, non-bank mortgage lenders with 5 or more loan applications in a metropolitan area must report property location for such metropolitan area, even if no branch office exists within that metropolitan area. J, the ethnicity, race, and sex of the applicant or borrowers and the gross annual income relied on in processing the loan application. K, type of entity purchasing a loan that the institution originates or purchases and then sells within the same calendar year. L, the rate spread for originated loans when the difference between the APR and the average prime offer rate is equal to or greater than 1.5% for loans secured by a first lien on a dwelling or 3.5% for loans secured by a subordinate lien on a dwelling. The difference between the APR and the average prime offer rate must be reported. This data is reported only on loans subject to truth in lending. For purposes of determining the rate spread, use the average prime offer rate in effect on the date the interest rate on the loan was set. M, whether or not the loan is subject to HOEPA, Home Ownership and Equity Protection Act. And N, the lien status of the loan or application, first lien, subordinate lien, or not secured by a lien on a dwelling. 7, data on ethnicity, race, and income. These data must be collected on the form prescribed in Appendix B to Reg C. If the application is taken in a face-to-face interview and the applicant chooses not to provide this information, the lender must inform the applicant that he or she must note the data on the basis of visual observation. C, these data may be, but does not have to be, collected if the loan is purchased by the financial institution or for applications taken by a bank, savings association, or credit union with assets of $43 million or less on the preceding December 31st. D, if the application is taken by telephone, mail, or internet, the monitoring information must be requested. On telephone applications, the lender must verbally state the collection request. If the applicant does not complete the information, the lender may state the information was not provided on an application received by mail or telephone. If the application is taken via electronic media with a video component, the application is to be treated as if it were taken in person, and collection of information on race or national origin and sex is required. Optional data 8. A, B, and C. A, requests for pre-approval that are approved but not accepted. by the home applicant. B. Home equity lines of credit made in whole or in part for home improvement or home purchase purposes. C. If the loan is denied, the reason for denial. The Office of Comptroller of Currency requires institutions that they regulate to report reasons for denial, even though doing so is optional under HMDA and Reg C. State chartered savings associations regulated by FDIC are also required to report reasons for denial. 9. Data for the following types of financing shall not be reported. A through F. A. Loans originated or purchased by the institution in its fiduciary capacity. B. Loans on unimproved real estate. C. Temporary financing, for example, bridge loans or interim construction loans. D. Purchase of an interest in a pool of loans. E. Purchase solely of servicing rights. F. Loans acquired as part of a merger or acquisition, or as part of the acquisition of all of the assets and liabilities of a branch office. 10. Data must be updated within 30 calendar days of the end of each calendar quarter in which final action occurred. 11. Inaccuracies or errors of law reporting and compiling are not construed as violations if they are found to be unintentional. Bank must prove reasonable procedures are used throughout the year to ensure the accuracy of the compilations and reporting to their federal agency. B. Reporting loan data. Loan data must be sent to the regulatory agency that governs the financial institution by March 1 of the year following the calendar year for which the loan data are compiled. 2. Institution must make its mortgage loan disclosure statement available at its home office for inspection by the public within 3 business days after it receives it from the FFIEC. 3. The disclosure statements must be available within 10 business days after it receives it from the FFIEC in at least one branch office in each metropolitan area in which the institution has such branch offices, or post the address in the lobby for requesting the statement in each branch office. It must mail or deliver a copy of the disclosure statement within 15 calendar days of receiving a written request. 4. The disclosure statements available in the branch offices need only contain the loan information from the metropolitan area where that branch is located. Institutions must make their law modified to exclude identification number, date application received, and date action taken available to the public by March 31st for requests received on or before March 1, and within 30 days after receiving a request after March 1. Disclosures must be available for inspection and copying. 7. Institutions must post a notice about the availability of their HMDA information in the lobbies of their home offices and any physical branch offices located in metropolitan areas. C. Record retention requirements. Disclosure statements must be kept for 5 years from the time they are received from the FFIEC. HMDA loan application registers and modified laws must be kept for 3 years. Enforcement fear of penalties is $7,500 per day as usual, $37,500 per day if violations or unsafe or unsound practices are engaged in recklessly or are part of a pattern of misconduct that causes more than a minimal loss to the bank or any pecuniary gain to the parties involved, and penalties up to $1.425 million per day against persons who knowingly commit a violation and knowingly or recklessly cause a substantial loss to the bank or a substantial benefit to the party. That completes the section on HMDA.